US consumer confidence takes a significant hit. Is the worst over for the Indian economy, and why Netflix continues to remain an investor darling? This is Vinay Uttam, your resident stock doctor, and welcome to a brand new episode of the Stock Doctor podcast. Yep, got a change of my looks. Just got a very long, haircut after a long time. Really kept it short, so I don't know whether I look absolutely weird or not. It started to grow back again. But yeah, I did get a haircut just to let you know that I mean, in case you, yeah, different look. But this is the stock doctor. Yeah, it's nobody. It's not an imposter. Also, guys, really a bit late to the party this week. I have to blame the London weather on this one because there was relentless cold and it was rain, and that gave me a sore throat, a nasty cold. It was didn't have a voice to record, so that's why it kept me on the sidelines for most of the week in terms of prep, as well as couldn't record it in this week. But feeling much better now, thankfully. So hopefully I can continue to be back by I can continue to be on our usual Sunday 7 p.m. British Standard Time from next week onwards. But apologies, very sincere apologies. It was got to blame the London weather on this one. It's still cold, but I'm really hoping that again I don't fall ill again. Right. As we gear up for what is the Super Bowl of Q4 earnings season, yeah, with Nvidia reporting in its numbers on Wednesday, markets entered the week firmly on the back foot, and so it's not just it's not just the nasty cold I had in terms of the markets as well. It was not good news at all last week, neither in the Indian markets nor in the US markets. So. And given the fact that all eyes will be on Nvidia as it reports tomorrow, actually, after the bell, 26th of February, it reports after the bell. Markets enter the week firmly on the back foot as weak economic data, weak guidance from US consumer bellwether Walmart, more tariff news, and a relatively hawkish Fed all led investors to close out the week feeling nervous, jittery, and bearish. Once the dust settled on last week, it was red across the board for the US indices, the Dow tumbling 2.5%, S&P 500 slipping 1.7%, and the tech-heavy NASDAQ also tumbling 2.5%. And I'm recording this on Tuesday. This episode will be released on Tuesday. Just to let you know, Monday wasn't particularly great either, with markets ending in the red. And as per pre-market, just before recording, I did check the pre-market. It doesn't look good either. So Nvidia, all eyes would be on you, and if more on that later, right? So I've got lots to get through. So what I'm going to do is I'm going to quickly welcome you guys to the Doctor's Weekly Snapshot, as always, and take you through all the major developments that took place in the US markets last week. Let's start with the big one of the primary driver of last week's sell-off, and that was Walmart's Q4 earnings numbers, more specifically, the guidance, right? There was nothing wrong, absolutely nothing wrong, I have to say, with Walmart's Q4 earnings performance in particular. And I'll be doing a separate Dr. Dissect segment in the coming weeks on Walmart's Q4 earnings and the implications for Walmart investors. But just to give you a sneak peek, it was a very strong holiday quarter performance from the consumer bellwether. You had revenues, operating income, comparable sales in the US, all coming in extremely strong. E-commerce sales for Walmart also performed remarkably well, growing by 20%, driven by demand for grocery delivery and store pickup services. The company continued to attract shoppers across income levels, including the higher income households earning $100,000 or more annually, particularly for non-grocery items. This is a trend that Walmart has been doing for a while, and the holiday season suggested that the trend was continuing. However, here's the problem. Despite the strong performance, shares stumbled about 6% post the report and caused a widespread sell-off across the markets. And this is because of a very cautious outlook offered by the management. More specifically, revenue growth in FY26 is projected at 3 to 4% compared to the 5.1% increase seen in fiscal 2025. So as we go into FY26, the revenue growth has now slowed from 5.1% to 3 to 4%. Operating income is expected to grow faster than revenue, but the guidance once again came below investor expectations. Finally, adjusted EPS was forecasted to come in between $2.50, $2.60, well below Wall Street's estimate of $2.77. So across the board, all key metrics remarkably not performing as per investor expectations. And this is exactly what led to a sell-off in Walmart shares and a sell-off broadly in general. Walmart executives cited global economic uncertainty, potential tariff increases under the Trump administration, and cautious consumer spending as the main reasons for their muted outlook. Now, the question you need to ask yourself, whether you're a Walmart investor or not, and I most certainly am not, but I'm looking into the company given the sell-off it's been seeing. Now, more on that probably in the coming weeks in Dr. Dissects. What you need to know is whether you're a Walmart investor or not. The question you need to ask as an investor is whether the consumer bellwether Walmart's guidance was too conservative or whether it was a reflection of reality. And now that currently is up for debate. But one thing the company's executives seem to have got right was the cautiousness creeping, was the degree of caution, the degree of cautiousness creeping in to the US consumer. This was further reflected in the results of University of Michigan's February survey, the consumer sentiment survey, which showed that its consumer sentiment index fell sharply to 64.7 in February, which was not only down from 71.7 in January. That's a remarkable drop in sentiment, guys, in 1 month. Yeah, 71.7 in January to 64.7 in Feb. And it also missed economist expectations significantly. The expectations were 67.8. So Walmart's executives might be onto something when they say the US consumer has become more cautious. Clearly, sentiment has gone dramatically negative. The drop reflects growing concerns. The drop from 71.7 to 64.7 reflects growing concerns among consumers about the economic impact of tariffs on imported goods, which are expected to drive up prices. The decline in consumer confidence was consistent across all demographic groups, including age, income, and wealth levels. So whether Walmart attracts $100,000 or not doesn't really matter because the sentiment across the board was negative. And to make matters worse, these very consumers now expect inflation expectations for the year to come in at 4.3% in Feb. They were expecting inflation to be at 3.3% in January for the entire year. Yeah, so entire year in January, when the sentiment index was, when the survey was done, expectations were 3.3%. Now it surged to 4.3%, and this surge, this 4.3%, is the highest level since 2023. This reflects heightened anxiety about rising costs among consumers, primarily due to fears of tariff-induced price hikes. You see the common pattern here: tariff, tariff, tariff across the board. In a separate report, Chicago Fed National Activity Index, we got data from there, which measures, and this data measures economic activity, and it dropped to minus 0.03 in Jan 2025, down from a revised 0.18 in December 2024. Now, it's very simple. If the reading goes negative, it means the economic growth is below the long-term average. Positive means it is above the long-term average. Clearly, minus 0.03, I don't need to tell you, is negative. It's below zero, which means the economic growth is below the long-term average, which signals weaker momentum at the start of the year. According to the index, reduced production output, lower levels of personal consumption, and weakness in the housing sector all contributed to this particular drop in economic performance. Now, this week might belong to NVIDIA, but we are due to get the Fed's preferred inflation gauge, the PCE number for Feb, this week as well. So a whole lot, I'll have a lot more to cover for you guys in the next episode. And if it follows, if the PCE follows the same path as CPI, which was hotter than expected, then markets have every reason to worry. The Fed already seems to be worried if the latest Fed minutes are anything to go by, and that was yet another key economic, sort of data that we received. The minutes revealed that most Fed officials supported a wait-and-see approach, citing high uncertainty in economic conditions and the need for careful assessment before making additional monetary adjustments. Fed officials expressed concerns about factors that could hinder inflation control, strong consumer demand, and changes in trade and immigration policies, and business contacts across several districts indicating plans to pass on the higher input costs arising from new tariffs onto consumers. Markets have already brought their expectations of a rate cut down, especially after the hotter than expected CPI print and tariffs taking center stage. I think they're expecting, traders are expecting only one rate cut by the entire 2025. The most optimists among these traders, they're expecting two. Based on the minutes, the Fed officials appear to be doing the same. They don't anticipate any more rate cuts. They don't anticipate any more rate cuts in the foreseeable future. Maybe in the second half of the year, they will consider. Lot of economic data, but the point remains the same. US consumer has got extremely conscious. So bottom line, it was a week that showed the US consumer had started to factor in the impact of President Trump's tariff policies even before they were implemented, even before we knew what shape or form they would take. The rise in inflation expectations, to me, is particularly extremely alarming and could become an issue for the Fed. And the Fed, according to me, has every right to remain cautious, but the weakening consumer sentiment is the more worrying factor. Should this consumer sentiment, the weakened consumer sentiment, persist into March and April and so on, then we are in for a rocky period in the US markets. It also doesn't help that investors have become the most pessimistic about the stock markets since November 2023. So after having a blockbuster 23 and 24, there are cracks appearing in investor confidence when it comes to the US markets. If Nvidia disappoints on February 26th, then all bets are off, according to me, when it comes to US market action. As such, as far as I'm concerned, a bit of caution is definitely warranted at this time if you are an investor just like me. Over to you, Jensen, and let's move on to the next segment immediately. The doctor goes home. Right. Mixed picture from India as I take a sip of water. Mixed picture in India. The question now, we all know that Indian economy has been slowing down. We know that the markets have been tumbling. I looked at the markets today. They're in the red as well, just albeit, a little bit on the red, not particularly as much compared to the start of, compared to last week. But Monday was bad. Monday, the indices dropped 1%, 1.1. So we already know there is slowing growth in the Indian economy. But the question is the worst over for Indian economy, or is it going to continue to persist? That's the question. According to a certain report, according to some crucial reports and commentary that we received we received last week from various research firms and various policy makers and so on, it appears that the worst could be over for the Indian economy. On Sunday, BNP Paribas published a report in which it argued that the Indian economy is showing signs of recovery, with several indicators pointing to an improved outlook for FY25 and beyond. Food inflation, for instance, if not the biggest driver of India's inflation, has begun to moderate, as evidenced by Q4 data, after remaining persistently high through 2024. Tax collections have significantly improved after what was a dismal third quarter, signaling gradual economic stabilization despite ongoing challenges. Then there's the blockbuster budget 2025. I touched upon it multiple times, but mainly I touched upon it a couple of episodes back. There's the blockbuster budget 2025, through which the Indian government introduced measures to stimulate consumption by increasing income thresholds and relaxing the tax slabs under the new tax regime. According to the report, 30 million salaried individuals are expected to benefit. According to the BNP Paribas report, 30 million salaried individuals are expected to benefit from these reforms, with the increased disposable income subsequently expected to drive discretionary spending across sectors such as durables, automobiles, healthcare, travel, and jewelry. You already know the sectors you look into, right? Durables, consumer durables, automobiles, healthcare, travel, and jewelry. The higher incomes are also expected to improve retail asset quality, particularly in unsecured loans. Furthermore, the government is focusing on fiscal consolidation while stabilizing capex allocations. For FY26, for instance, capex is set to increase, capital expenditures, or capex is set to increase by 7.4%, emphasizing infrastructure investment while reducing subsidies. BNP Paribas and the report by BNP Paribas now expects fiscal deficit to decline to 4.4% of the GDP in FY26, slightly better than what previous estimates were suggesting. India's GDP growth is also expected to surge significantly in the second half of the year at 6.7%, which should bring the overall GDP growth for FY25 to a more respectable 6.4%. Things were looking much grim at the start of the year. So a second half, should this report be right, or the ballpark, should the actual growth come anywhere near the ballpark figure suggested by BNP Paribas, then we're going to end the year with a respectable, still not sky high, but definitely 6.4 is a respectable figure. All in all, this latest report gives investors like you and I a lot to be positive about. Let me rephrase that. Gives long-term investors like you and I are a lot to be positive about, as it suggests that the worst economic challenges may be behind India, and with fiscal measures and moderating inflation supporting a gradual recovery. Then there was some positive news with respect to India's labor market. According to the latest employment data, the unemployment rate in urban areas for individuals aged 15 years and above stood at 6.4% during the October to December 2024 quarter. Now, while this rate was the same as the preceding July to September quarter, it was marginally better on a year-over-year basis when the unemployment rate was 6.5. So October to December 2023 quarter, it was 6.5%. 12 months passed, it's dipped to 6.4%. Any dip is good news. The labor force participation rate, age 15 years and above, in urban areas increased to 50.4% in October to December 2024, up from 49.9% during the October to December 2023 period. So once again, this rate was very steady on a sequential basis, but has increased more than, better than the unemployment rate. It's increased at a higher rate than the unemployment rate did. 50.4, 49.9, 0.5% increase, always good news. Now, among females in urban areas, the unemployment rate declined to 8.1% in October to December 2024, compared to 8.6% a year ago and 8.4% a previous quarter. So steady decline among female unemployment. For males, the unemployment rate was steady at 5.8% during October to December 2024, showing no significant change from either the previous quarter or from the year ago period. While the improvement in female unemployment rate was welcome news, the gender disparity continues to be persistent. Overall, though, despite the slowing economic growth at the start of the fiscal year, the Indian labor market has been steady, and the increasing labor force participation rate was yet another sign that things could finally be turning around for the Indian economy. Finally, there was some positive commentary from Saugata Gupta, MD and CEO of FMCG giant Marico. I'm an investor in Marico. It's a long-term in holding for me. Been doing it. The company has done really well over the years. But there was some positive commentary coming in related to the growth potential of India's rural markets, the Bharatian heartland, as they say. Mr. Gupta identifies the rural market as being at a very critical inflection point, offering long-term growth opportunities for FMCG companies. Yet another hint there, FMCG sector. Maybe it's a time to take a look at it. Factors driving the shift, according to him, include rising per capita income, increased government infrastructure spending, and higher minimum support prices for crops, which have collectively improved the quality of life in rural areas. It was also a positive sign to see that for the fourth consecutive quarter, rural markets outperformed urban markets in growth, albeit from a smaller base. So if you look at all the data points, I'm giving you plenty, this episode is dedicated to a lot of data points. If you look at all the data points and the commentary, one can clearly see that the Indian economy is showing signs of recovery, which should drive consumption, investment, and subsequently earnings growth. With the RBI now having entered a rate cutting cycle, when you combine all of this with the stimulus measures of Budget 2025, then for long-term investors, a lot is there to cheer. However, having said that, I am going to end the segment with a caution because I'm going to still keep that champagne bottle on ice. Still not going to pop open the champagne and celebrate. This is because in the short term, there are enough headwinds as far as the Indian stock markets are concerned. And for that, all you got to do is just have to see the action of foreign institutional investors, who just continue to pull money out of India. FIIs have pulled out over 1.12 lakh crores from Indian equities in 2025 so far, and we're barely into 8 weeks into the year, and it's already 1.12 lakh crores have been yanked out of the Indian stock markets, contributing to a year-to-date decline of 4% for Nifty. In fact, it's more if you include Monday's decline and the marginal decline that you saw Tuesday. As I record, the Indian markets are shut anyway. The outflows are part of a sell India, buy China trading strategy, as new initiatives by the Chinese president, Xi Jinping, and leading businessmen have bolstered investor confidence there. The Hang Seng Index has surged 18.7% in 1 month, contrasting sharply with 1.55% drop in India's Nifty. So there's a clear tactical shift there, a tactical trade that is taking place where it's sell India, buy China, simply because of the valuations were more attractive in China compared to India. Now, despite these significant outflows, Indian markets continue to remain overvalued relative to their peers. The valuation has become attractive, but still remain overvalued to their peers. And in the near to medium term, this is likely to be the case. And this is likely to be the case. So don't be surprised if FIIs keeps selling. However, with improvements in economic growth and corporate earnings, in the long term, the trend is likely to reverse. The trend is likely to be your friend if you are a long-term perma-bull like me. Then there's the so-called Trump's tariff tantrums. You're hearing it again. You heard it during his first term. You're going to hear it again, and you're going to hear it probably throughout his term until 2028. With President Trump repeatedly specifically calling out India and China as he plans to unleash reciprocal tariffs on every trading partner of the US, the markets continue to be jittery. RBI's February bulletin has specifically cited tariffs as a major reason for financial markets remaining on edge. According to the bulletin, President Trump's repeated threats of imposing reciprocal tariffs on India remain a major concern for financial market stability and is negatively impacting investor sentiment. So in the short to medium term, expect markets to remain volatile. We are already, we already started the week once again in the red. Like I said, Monday was bad. Tuesday has also been bad. But the relentless selling has actually resulted in opportunities to pick up some high quality names at attractive valuations. And given that the Indian economy is on track to recover thanks to stimulus measures, RBI's rate cutting cycle, and moderating inflation, along with factors such as digital information and infrastructure, digital transformation and infrastructure development, the selling spree you see in the Indian markets shouldn't deter investors like you and I from the fact that India's long-term growth story remains firmly intact. As such, whatever near-term trading strategy or medium-term trading strategy is causing pain, long-term investors, in my opinion, need to see this as an opportunity of a lifetime. On that note, we're going to head to the final segment, Dr. Dissects, where one of my favorite companies in recent times is making a comeback. And the stock that is going under the microscope is none other than the streaming giant Netflix, ticker NFLX. Now, Netflix reported its Q4 earnings last month, and unsurprisingly, it had a fantastic quarter. This has become a trend for Netflix as far as I'm concerned. By the way, I am a Netflix shareholder. It's a long-term holding for me. I recently got into a position, but I plan to hold it for the long term. It's not a short-term tactical trade or any of that sort. It is a proper long-term holding for me. And it is one of my biggest positions in the portfolio. So, it's been a trend for Netflix whereby it just keeps delivering quarter after quarter after quarter, amazing performance after performance with each passing quarter. Q4 revenues were Q4 was no different. Q4 revenues of $10.25 billion were up 16% year over year and comfortably beat analyst estimates by 138.1 million. Diluted EPS came in at $4.27, up a whopping 102.3% year over year and beating analyst estimates by 6 cents. The company's net membership adds or net adds, a metric that the company is reporting for the last time. Remember, from next quarter, quarter one of FY25, company will not be reporting this net membership ad metric. This metric came in, and what a way to finish here, by the way, because this metric actually came in at 18.91 million, blowing past street estimates of 9.6, more than nearly doubling. What a way to end. And we're going to report it for the last time, and we just doubled it, guys. It was the biggest quarter of net ads in the company's history, going out with a bang by all stretch, by all metrics. Overall, the company finished 2024 with 302 million members. The considerable levels of spending, as reflected by a decline in cash flows, are translating into strong profitability, as evidenced by strong operating margins, which came in at 22% compared to 16.9% during the same period last year. For the full year, the company generated $10 billion in operating income, the first time that this metric has crossed the 10 billion mark in the company's history. As far as the guidance is concerned, for the full year, the company now expects revenues to come in between 43.5 and 44.5 billion. Operating margins are expected to come in at 29% for 2025, up from the previous forecast of 28% and 2% percentage points up from 2024 figure of 27%. Those are the numbers. We don't just discuss numbers, we dissect, we do a deep dive of the analysis in the segment. So let's do that. Now, if one does a deep dive on the company's net membership additions coming in at more than double the street estimates, then one can easily conclude, in my opinion, that the unique Q4 attractions, such as the Jake Paul versus Mike Tyson fight, as well as the Christmas Day NFL games, are likely to be the main catalyst. After all, the Jake Paul versus Mike Tyson fight was the most streamed sporting event ever, and the NFL Day games became the most streamed NFL games in history. Moreover, in addition to these sporting events, there was also the second season of Squid Games. Wonderful. I mean, do check it out. As good as the first, which racked up a whopping 165.7 million views. Now, based on these facts, one could be tempted to conclude that the membership jump was a one-off and that due to these events being Q4 specific, membership numbers and subsequently engagement could fall in the coming quarters. I will not blame you if you go jump into that conclusion. However, keep this in mind. During the Q4 earnings call, management confirmed that this was not the case and that they actually saw broad strength across content categories across all regions, thereby implying that the two main attractions of the fourth quarter were not the main drivers of the surge in memberships. Furthermore, management also mentioned in no uncertain terms that their estimate for subscriber additions as a result of, Squid Games, Jake Paul and Mike Tyson fight, NFL games, all of this represented it represented a minor figure compared to the total net ads during the quarter. Again, management commentary is not surprising in my opinion and becomes even more evident when one simply looks at the viewership metrics for some of the company's other content that was released during the quarter. Examples include Carry On, fantastic movie, 160.1 million views. Season 2 of The Diplomat, again, brilliant, 21.4 million views. Season 3 of The Lincoln Lawyers, fantastic, love it, 33.9 million views. That Christmas, haven't seen it, but got 63.8 million views. And Our Little Secret, once again, haven't seen it, 84.4 million views. These shows and movies belong to different genres, with some of them returning seasons, which does suggest there wasn't the overall content slate that led to the surge in growth seen in membership additions rather than the one-off events. Q4 may have seen one of the biggest, strongest content slates that was released, but it doesn't mean that the overall content slate for FY25 is weak. On the contrary, the coming quarters could see even more solid content, in my opinion. Examples of the FY25 content slate include returning season of Squid Game. You heard that right, season 3. Wednesday, Stranger Things, the finale, series finale of that. Drive to Survive. And You, a new Knives Out movie titled Wake Up Dead Man, a Knives Out Mystery. Happy Gilmore 2, and R.I.P. starring Ben Affleck and Matt Damon. I mean, I'm losing breath just to give. These are just non-exclusive. Yeah, there's so much more. Just have to take the earnings call to figure that out. But once again, the shows and movies belong to different genres, which are therefore likely to attract a diverse audience. And then there's the entire content slate from WWE. WWE Raw has been a massive hit already with 5 million views during the first week, your doctor being one of them, nearly double the number that the show was attracting on traditional TV. In addition to Raw, the company has backed the rights to showcase SmackDown, every major pay-per-view event, WWE pay-per-view event on the platform outside the US. So the likes of Royal Rumble, fantastic. This I watched it. I stayed up all night to watch. What's that? WrestleMania, taking place in Las Vegas, looking forward to it. And SummerSlam, for the first time, it's going to be a 2-night event for SummerSlam, will be streamed abroad on Netflix. Are all expected to hit on the platform's international markets this year. Given the company has already seen a 25% jump in non-live viewings on the day after the live event, it is clear that the company's strategy of bagging the WWE streaming rights for its international markets is already starting to pay off. The Jake Paul versus Mike Tyson fight, the Christmas Day NFL games, Squid Game Season 2 have all certainly played a major role in the company attracting new members during the fourth quarter. But to conclude that they are the reason for the surge in memberships, they are alone, they're the sole reason for the surge in memberships would be inaccurate in my opinion. And to expect the membership growth to taper off both in terms of numbers and engagement in the coming months would also be the wrong conclusion, in my opinion. The content engine of Netflix has not stopped, and with the company having finally established a perfect blend of scripted shows, movies, documentaries, and live events, it is well positioned to not only dominate the streaming world, but also make significant gains in areas such as connected households and markets that remain underpenetrated. Next, the last time I talked about Netflix, I mentioned how there was uncertainty surrounding the company's ads business. Q4 removed a lot of the uncertainty, in my opinion, by offering some significant insights into how the company's ads business has been performing. First, management announced the company's ad tech platform, which it launched in Canada, has been a success, and that the company now plans to roll out the platform in the remaining ads countries in 2025, with the United States being next in line. Management also announced that the company is on track to reach sufficient scale for ads members in all the countries where the plan is on offer in 2025. This was based on the evidence that 55% of the signups in Q4 were for the ads plan, and the overall membership on the company's ads plan for Q4 jumped 30% sequentially. After announcing a set of price rises in the previous quarter, the company announced fresh price increases across most plans in the US, Canada, Portugal, and Argentina, thereby demonstrating the management's confidence in the progress on its strategy to pivot to ads. Just to let you know, UK, if you're watching, if you're listening, if you're in the UK, if you're watching it from the UK, if you're watching the show on the UK, the Netflix, you received an email, and you're a Netflix subscriber, you received an email saying there is going to be a price rise in the UK as well. I received the email and I was like, oh, well, but I mean, didn't see that coming. This was for, so it's price rises happening across the board. Now, the overall commentary provided by the management following it up with tangible data. This is the kind of clarity and confidence that I wanted to see from the company with respect to its ads business. Furthermore, one of my biggest concerns, which was whether the company's first-party ads platform would work flawlessly or not, has been removed. As such, I now firmly believe that the company's ads business is well positioned to be a major growth driver in 2025 and beyond. And now I'm going to move my chair a bit, turn around, find my book, because where is my book? There it is. There's my book, hiding among some other books. Got the book, got the pen, can only mean one thing. It's valuation time. Now, as mentioned earlier, so management expects FY25 revenue. So now we're going to discuss, this week is Netflix, right? FY25 revenues, revs between 43.5 and 44.5, 43.5 and 44.5 billion. Okay. Now, despite Squid Games 2 already released, it's on track to become one of the most watched original series seasons ever, by the way. The company still has Stranger Things series finale, new seasons of The Night Agent and Drive to Survive, Knives Out movie, Happy Gilmore 2, blah, blah, blah. And also not to mention WWE events such as WrestleMania, Royal Rumble, SummerSlam, everything that I've repeated in the past to look forward to in 2025. Last time I talked about Netflix, I mentioned that I am of the opinion that the company would match the high end of their FY25 forecast. So I maintain the same stance. And as such, I'm also raising my revenue expectations to 44.5 billion. Okay. And that's just a $500 million rise. For my calculations, okay, the updated high end of the company's guidance. Now, management expects FY25 operating margins to come in at 29%, up from their previous forecast of 28%. Now, Q4 and FY24 full year results have confirmed my previous stance that despite spending high levels of cash, the company has managed to improve its profitability significantly. I don't see the trend changing in FY25. Management's confidence has been backed by results, and therefore I believe that the updated operating margin guidance of 29% is a reasonable estimate. As such, I have assumed operating margins of 29%, and which will translate to operating margins projection of 12.9 billion, right? So 12.9 billion in dollar terms. 12.9 billion in dollar terms. Now, I've assumed FY non-operating expenses to be 662 million. So non-op expenses to be 662 million, which is the average of the net non-operating expenses in the last 5 years. Okay, so 44.5, 12.9 operating margin, and 662 million. Okay, right. So I'm reducing my effective tax rate to 12.6%, same as FY24. So tax rate is 12.6%. So if you take all together, then projected FY25 net income will be 10.7 billion. Okay. FY25 net income would be 10.7 billion. Okay. According to the company's latest income statement, the weighted average shares of common stock used to calculate the diluted EPS was 437.8 million. And that means FY25 diluted EPS is expected to come in at 24.44, slightly higher than my previous estimate of 23.06. So 24.44 is the diluted EPS. Now, the company, according to LSEG data, currently trades at a forward PE of 36, which is slightly higher than its historical 5-year PV multiple of 34. Now, the company's FY24 earnings growth, believe it or not, was 64.9% year over year, more than double its average long-term growth of 28.8. However, according to my estimates, FY25 EPS growth is expected to come in at 23.2%, a sharp decline, but nearer to its long-term average. So on a non-GAAP basis, the company's forward price to earnings to growth ratio stands at 1.67, according to Seeking Alpha, slightly above its 5-year average of 1.5. Based on 1.67 PEG, and 23.2% projected earnings growth, the projected forward PE should be 38.7, right? 38.7. Projected forward PE should be 38.7, which is around where it's currently trading. This is the forward price to earnings estimate that I've assumed for my calculation. So now you have 38.7, multiply that with 24.4, and you get 946 is my updated price target, which just shows that Netflix is overvalued by about 6% from current levels, just about 6%. So so I'm definitely not shorting it. While my price target is definitely well above my previous target of 782, I am putting a hold rating on Netflix simply because it's it's just blasted past the price target anyway. So I'm going to maintain the price target at 946, and I'm going to put a hold rating on the stock. While I'm not selling my shares since, I'm not going to sell any of my shares. I do want to capitalize on the momentum. It has an A grade rating on the Seeking Alpha momentum scale. I'm neither adding to my position nor am I recommending new investors to chase the post-earnings rally at current levels. Now, having said that, since the entire momentum trade has been, I'll take a minute or so to explain this. The entire momentum trade in the US markets has been crumbling. Okay, you can see the likes of Palantir, Robinhood, all of that completely, they surged past everything, defying expectations, and now they have met a certain person called gravity. Yeah, and now they're coming down. So Netflix has also been one of the victims because it blew by one point. It was trading at 1,034, 1,035, 1,030, 1,040, and now it's come down below 1,000. So maybe any more breakdown in momentum, even though it's outside my price target, you could still go in and get a small position into it. And then if it does get to my price target and below, then add to it. So I'm not going to say wait until below 946 to buy. It's never, I think the ship has sailed past. However, from a fundamental point of view, price target is 946 for now. However, what I would say, I'm not going to give you investment advice, but if I were you, should the momentum break down and it gets to a significant decline in the stock, then worth definitely starting a very small position. I mean, I might look to add to my existing position, actually, even though my cost base is far, far lower than where it is right now. Bottom line, Netflix had a strong finish to the year, beating on both the top and bottom lines estimates in the fourth quarter. The company has also managed to add nearly 19 million new members, more than double the estimates. The guidance for the first quarter of FY25 as well as for the full year both came in very strong. The surge in memberships, in my opinion, is not due to one-off events such as the Jake Paul versus Mike Tyson fight alone. It is a reflection of the company's ability to continue to produce high-quality, diverse content and with a very strong content slate set for 2025. The membership growth trajectory, both in terms of numbers and engagement, remain firmly intact. The current quarter also saw some of the major uncertainties surrounding the ads business going away, as the company remains well positioned to utilize its ads business as a major growth driver for the future. The winner of the streaming wars was never in doubt. But based on the Q4 performance and looking ahead into 2025, the only question on investors' minds, whether you're in the stock or not, with respect to Netflix, in my opinion, should be when the next buying opportunity should be. That's all the time I have for you this week. It's a pretty long episode, but I really had a lot of data to share with you guys. I had a lot of information to share with you guys. I'm sorry for the Tuesday launch rather than the Sunday launch. Bad weather, got to blame the London weather, but its weather's looking better now this week for sure. So hopefully I'll be back on the usual Sunday time. That's all have the time I have the time I have for you. That's all the time I have for you this week. Unfortunately, if you have a specific Indian or US stock suggestion for the doctor to diagnose and dissect, do tweet me at Uttam Vinay, UTHAMVINAY, or email me on the Stock Doctor Podcast at gmail.com. Thank you once again for listening. I will see you later this week. Until then, stay safe and make some money.